Hey everybody, Mark Poole here. I'm a consultant with IG Wealth Management. After being in the financial industry for 8 years, I've decided to make some educational videos to help support my clients. So if you like what you see, please like and subscribe, and my contact information is in the description of the video. Enjoy.
Welcome everybody. I'm located right in Brandon here. If you have any specific questions though that may need answered, just click on the link that's going to be provided in the chat. It's actually going to take you right to our calendar, and you can book right in for a consultation if there's anything that you have specific that you need to ask for your situation. Two presenters today. So my name is Mark Poole. I was actually born and raised in Brandon. I've been in the financial industry for over 8 years, and I worked at one of the world's largest banks until August of last year when I made the switch over to IG Wealth Management. So I made that switch to better service and support my clients. One of my specialties when I was with the bank though was retirement and estates. So I've seen how important proper planning can be and what can happen when there is no plan. So our other presenter tonight, his name is Danny Case.
Thanks, Mark. So I started my journey in finance by going to ACC, where I got my diploma in business administration, specializing in financial services. And once I was done school, I worked with one of the local credit unions in the Westman area, and then made the jump to Investors Group or IG Wealth Management in 2016. And over the course of those last 4 years, it's been a great experience, and I've been enjoying it every day.
So just to kind of get us started off here, Danny's going to go through a little bit of an agenda and talk a little bit about the markets with us.
Yeah, so our goal today is to help you with your financial plan. In particular, we're going to be focusing on estate planning. So over the course of the evening, you may have questions. You can submit them through the Q&A, like Mark mentioned, and we'll try to get to them. But we're going to start off tonight by reviewing the markets, and then we're going to jump into estate planning, looking at the different situations and tax planning that goes along with that. And then we'll discuss some solutions that may fit your situation. Obviously, we're not going to be recommending anything tonight. We want to look at your particular situation if we're going to be doing that. But the last thing we're going to look at is what a financial plan really looks like. So let's get started. So for the last 11 years, we've been enjoying one of the largest economic expansions and biggest bull markets in history. But let's wind the clocks back to March 9th, 2009, and we're currently dealing with the global financial crisis. Governments are using taxpayer dollars to bail out the global financial system. As a result of the crisis, the S&P 500 was down 50%. At that time, it was believed that economies could not grow for years to come, and that the stock market would do the same. As you can see on the chart on the right, this was not the case. The S&P from that date to today's closing price is now up 371%. And that includes what we just experienced with COVID-19. Since March 2009, investors have been fearful of when the next crisis was going to occur. We have several of them listed here, and many of those events at that moment in time looked like they would be a barrier to future financial success. When there's uncertainty in the market, the first reaction of the market is to go down. Then it takes a period of time to recover. And that's kind of what we're going through right now with COVID-19. And then after these events, the market has continued to reach new highs after each one of these events have occurred. If you're invested in the global equity markets back in December of 2008, you would have experienced excellent market returns. As a result, or as you can see, the S&P 500, which tracks the US stock market or is one of the indices that tracks it, performed an average of 15.3% over that time. The MSCI World Index, which tracks developed nations around the globe, had an average return of 12.5%, the MSCI Europe, 8.9%, and here at home, the TSX had a return of 9.2% on average over those 11 years. If you had a portfolio that had 25% each index, it would have returned 11.3% on average over those 11 years. Now, most investors do not get those returns, and let's see why. So this graph demonstrates the S&P TSX from 1956 to 2019. Now let's imagine you had $10,000 in 1956 and you decided to put it in the markets. Now what happened over that time? Well, the markets declined by more than 10%, 24 times since 1959, which is indicated on the right-hand side of your screen. However, on average, your investment would have increased by 8.93%. So if you take that $10,000 you started with in 1956, today it would be worth over $2 million. So the key is to not panic and to stay invested when the markets go down. As illustrated in The Economist, how bad will it get? The short answer, we weren't really sure at the time, but as you can see, on February 23rd, the S&P closed at an all-time high, and on March 23rd, we hit what appears to be the bottom. During that time, the S&P 500 fell almost 34%. So as you can see from that date, we've started to rebound, and as we indicated on the last slide, we're anticipating that the markets are going to reach a new high eventually down the road. It's during those times of market volatility that make or break your investment portfolio. The chart you're looking at tracks the S&P 500, how it performed going back to 1980. So we're going to stick to the far left side. In 1980, the stock market went up 26%, represented by the blue bar. So 1980 was a good year for investors. You can see below the blue bar, however, there's a red dot. And what this dot represents is the inter-year decline of 17%. So what happened? Well, at the start of the year, the markets moved upwards. Then after a while, they lost momentum and started to go down. When the market starts going down, people have different tolerances to losses. So whether that be 7, 12, 15%, during that time, people wonder, should I be getting out of the markets? If you got out of the markets on the day of the red dot, when the market was down 17%, you would have lost 40% rate of return on your money. You cannot achieve long-term growth by consistently taking losses on your investments every time it goes down. You invest money to make money. So when the markets turn negative, stay invested, and that's how you win over the long term. If I could leave you with 5 things, these would be it. 1, have a plan and stick to it. What are your goals? What do the next 5, 10, 20 years look like? Ensure you have a diversified portfolio. You don't want to have all your eggs in one basket. Mark and I have come across some portfolios when we're sitting down with people for the first time that are primarily invested in Canada. And Canada only represents 3% of the world market. So you're getting a relatively small piece of the world, and you're not being properly diversified if something happens. Number 3 is invest for the long term. For people just starting out, you may have 50 plus years of investing. A market dip here and there won't drastically affect your plan. For people retiring at age 65, well, you still have 30 years of retirement. You don't want to be making knee-jerk reactions or short-term decisions that could drastically affect your retirement plan long-term. The 4th one, determine your retirement and estate planning strategy. So discuss with your spouse or plan for what you want to live off per year. What do you want to leave to your kids or to a charity? These are just going to be some of the questions you'll be asking yourself over the course of the evening. And the last one is take professional financial advice. All the information Mark and I are going to be giving you tonight is really good, but it's up to you guys to actually do something with that information. So now I'm going to pass it off to Mark, and he's going to focus on discussing planning your legacy and the importance of a well-structured estate plan.
Awesome. Thanks so much, Danny. Those points are exactly why having a financial advisor or planner in a market like that we're experiencing right now is paramount. Knee-jerk reactions could have cost a client, up to 35% of their retirement if they'd withdrawn all their funds around March 23rd. So, just as a side note, we do have actually some questions coming in already. It's nice to see we've actually got 2 people booking consultations already. I think one person had to leave, but that's fantastic. The first question, I'm just going to answer it really quick. Beverly's asked, I have all of my investments at the bank, but the bank is not doing appointments right now. How do I check on my investments? Well, simple answer is, even though your investments are with another bank, us as planners can see investments and funds from all institutions. So it's very easy for us to determine how your money is doing and if it's appropriate for these current market conditions. So hopefully that answers your question. So we're going to get a little bit into some estate planning. We'll call it estate planning 101, a little bit of school for everybody. And then we're going to do estate planning 102 with Danny here. So it'll be a little bit nicer here. Sorry, I'm just, I hope everybody was able to see the slides there when Danny was talking. Looks like we're having some tech issues here, but hopefully you can see them. What is estate planning? Estate planning is something that no one wants to talk about, but it is something that we have to talk about. Estate planning is a process of making a plan prior to passing to ensure that your assets transition based off of your wishes. Now, whether that be to family or friends or charities, some goals may include preserving the value of your estate. Essentially, this means paying less taxes, probate costs, lawyer fees, so on. I'm sure that we all can agree that the government gets enough of our hard-earned money while we're alive. So if we can keep that and pass it on to our children, then that's fantastic. So we have strategies to help you minimize those extra costs, and we will talk about them a little bit more in depth later on. Now, when estate planning, we don't want to just look at your will, but also beneficiary designations and family structure. We also look at how you hold your assets. This means like what type of accounts you have, what investment types, and what class of investments. Also property and homes, cabins, cottages, even farmland that can actually have a huge taxable consequence in the event of an estate if they're not properly managed. So you may be asking why family structure is so important. Well, in this day and age, blended families, is a huge thing. The family dynamic can be very complicated. When blended families, you can have ex-spouses, you can have new spouses, you can have children from a previous marriage, you can have children from a current marriage, stepchildren, the list goes on forever. But in order for you to achieve your wishes and make sure that your estate is divided fairly and accurately, you need to have a proper estate plan. Without proper planning, children or spouses can be disinherited. Essentially what that means is cut out from the estate completely. And really they have no recourse after you've passed. So how can this happen? Well, I've seen too many times over the years families that are already dealing with a loss, but now have to spend years in the court system and countless dollars to try and fight improper planning. This is a quick example of something that I've actually seen myself. So it hits home for me to see this happen in real life. But in this example, let's say the husband goes through a divorce and he has 3 children. He meets a new partner and they get married. The husband has lots of assets and property, but he has no will. This is called passing away intestate. So he passes away, and because he has no direct beneficiaries or will, all of his assets move to his new spouse. Now, essentially, all of his children become disinherited. Imagine you're already dealing with your father's estate just to find out his life savings, possibly the home you grew up in, was gone forever. A proper will and planning could have ensured that his children, his spouse, and his stepchildren are all taken care of as per his wishes. Now, let's look at what comfort and peace of mind an estate plan can give you. So there's a few points that we're going to go through here. It just really illustrates the ease that it'll give you. So make sure that your wishes are laid out clear and concrete so that everybody can understand what you're wanting. It minimizes taxes and other costs like probate and fees. Danny's going to go into this a little bit later on. It'll provide for your dependents after you've passed. And for any of you who might possibly have a dependent with special needs, that raises even more concerns. So we won't be going into this today. But if this is something in your situation, please book a consultation, as this is something that needs to be discussed. So another thing that I've seen a lot of when dealing with estates is minimizing delays in finalizing your estate. Some of the costs involved with, let's say, funeral or ongoing bills, maybe hydro or keeping up the household, your family have to pay those in the meantime. So having an estate taken care of in a timely manner is important, and because we don't want to cause them any financial hardship in this tough time. Now, you also want to maintain control of your assets from beyond the grave. Again, this is just making sure they go to where you want, and minimize work for your executors. Believe me when I say that simple wording in a will, lawyers are very good at this, but sometimes they can be, they do a lot of these all the time, but simple wording can make the job very difficult and costly, or it can make it very easy. So ensuring your beneficiaries are treated fairly. And lastly, ensuring that your charitable wishes are taken care of. Now, this is something that comes up quite a bit. People are starting to catch on to it, which is fantastic. But let's say if you're leaving 10% of your estate to charity, problem is that you run into the charity now has the right to essentially audit your estate process to make sure that they're getting their full 10%. So they get to check and see what you're spending money on, whether it's flowers for the funeral or anything, hydro bills, paying that kind of stuff, because they want to make sure they're getting their 10%. So an easy way to get around this is just to leave a set dollar amount, like $10,000 as opposed to 10%. Now, when it comes to children, should fair mean equal? Although fair doesn't always mean equal when dividing an estate between children, if they don't get the exact equal amount, will they consider that fair? Well, try not to get too specific with who receives what. It's impossible to know what you might actually own at the date of death and the value of each asset. So usually what we recommend is that you simply divide your estate into equal parts. Children can choose which assets that they want to buy from the estate using their portion of the inheritance. So just makes things a lot easier and it causes a lot less fighting. So let's look at an example that we've drawn up here. Let's say you have a couple, they have 3 children. One of the children still lives close to home. They're very attached to your cottage, because they live close to home or at home, but it's worth $600,000 today. Children 2 and 3, they live out of the province and have no interest in the cottage whatsoever, as they barely frequent it. And as of today, you have $1.2 million in savings. Let's say that's including RSPs, tax-free savings accounts, and pensions. So your estate split in today's dollars works out to child 1 getting a $600,000 cottage, child 2 and 3 splitting the inheritance of the cash value of $600,000 apiece. Now that seems fair. But let's fast forward 10 years into the future, and let's just say that the will hasn't been reviewed in 10 years. Well, now the cottage is worth $1.1 million, and maybe the retirement savings has been depleted due to regular retirement spending or market conditions. It's depleted down to $800,000. Well, now child 1 is getting $1.1 million cottage, and child 2 and 3 are only getting a $400,000 inheritance. So this is where a little bit of animosity can come into play, and things maybe don't seem too fair. So there are ways to get around that. One way is to use insurance techniques to help kind of close those gaps. And again, Danny's going to talk about that a little bit more later on. So an up-to-date will is paramount. I can't stress this enough. Having an up-to-date will and reviewing it regularly is the key to having the best estate plan. But the most important thing and the first step is to go and get that updated or get one drawn. So some of you may have a will, and when the last time it was reviewed might have been recently, might not have been recently. But did you review it in conjunction with your investments and your direct beneficiaries? So if you have a financial planner or an advisor, did you check with them as well? Because you could have assets that are passing outside of the estate. So your will names the executor, who essentially is the person that steps into your shoes and will act on your behalf to make sure that your wishes are being taken care of. Your will plans for the treatment of your assets. So what that means is your vacation properties, your house, your maybe businesses that need to be taken care of. Any charitable giving intentions. So that's where you would have that portion in there that I talked about earlier. And protecting an inheritance if beneficiaries are young or maybe financially responsible. everybody has somebody in their family that's financially irresponsible. So, protecting those people from themselves sometimes is something that the executor has to do. So your will also consider your unique situation. So whether it comes to blended families, common law couples, special needs beneficiaries, again, this is something that's outside of the norm, but it has special procedures. So if that is something that you have to deal with, make sure you book a consultation, because it's something that you should discuss with somebody to make sure you know how that works. So who should you pick to be your executor? In a will, in a state, personal representative and executors have the same meaning. So a person who is responsible for administering the estate. You want to find somebody that's willing and able to do the job, mature enough, has the integrity to do it. But the main thing is, and I've seen this so many times, you have to make sure that you have somebody that is able to do it. So what I mean by that is, you don't want to be picking one of your children that has 2 full-time jobs and 3 children at home. It's going to be very difficult for them to take off time and go and take care of the estate. You want to make sure that they're Canadian residents, preferably living in your province. And again, this is to keep your costs down, so you're not dealing with multiple lawyers, and preferably not a U.S. citizen or green card holder. We're pretty lucky up here with CRA, as much as we don't like it, but you definitely don't want to get the IRS involved. So, also from past headaches, I've had multiple executors on estates where they had to act in conjunction with each other. So all 3 of them had to sign. Problem that happened was, over the years, they'd moved out of province. So they had, one was in Alberta, one was in Ontario, and one was in Manitoba. So every time they even want to pay a hydro bill, make any changes to the estate, they had to courier documents all over the country. It made things really difficult. So those are things to consider. Now, a lot of people think that executor is the same thing as power of attorney, and vice versa. So what is a power of attorney? Well, they are very similar to the same thing, except for a power of attorney is someone that can step into your shoes while you're still alive. Now, that would come into play maybe if you had an accident, or maybe became mentally incapable of making decisions, whether that's from illness or anything. So, this kind of stuff, you need to have that in place, because if something needs to change with your finances, maybe you need bills paid or investment decisions made, you need to have somebody there that can do that. They usually do a power of attorney at the same time of doing a will. Now, reviewing and updating your will, you want to review and reconsider your estate plan in the event of life changes, or I call them milestones. Some of these, for an example, would be maybe getting remarried, or a common law relationship. In Manitoba, that's 3 years, but the government considers it 1 year, the Canadian government. Children, if you had new children or stepchildren or grandchildren, separation and divorce, loss of a spouse or partner, even taking into consideration bankruptcies, especially if you have children joint on accounts, because their bankruptcies and separations can affect you. So you want to schedule a review for your will every 3 to 5 years minimum. That's even if you don't have anything else like this happen. If you have one of these other milestones happen, you'll want to get in and review it right away. And don't forget to update your beneficiary designations on your registered plans or life insurance policies. So separation and divorce, none of us plan for separation or divorce, but it is a reality. So even children's divorces and separation are something to consider. So have you updated your wills and beneficiary designations? These are things that you'll want to look at if you do see a separation happen in your family. Is your ex-spouse still listed as a recipient as part or all of your estate? If you have young children, will they now be the beneficiaries? You'll want to update your will to show that. And if they're underage, we'll want to have a trustee for them. And beneficiaries designations should always be changed to estate if you don't have someone other than your ex-spouse to put on there. Now, we definitely don't want to cut grandchildren out of the will, but there is problems that can arise from having grandchildren listed as beneficiaries. Now, some of those things to consider is, what if other grandchildren are born after you pass away? You could have 3 grandchildren, get money going towards school, and you have 2 that were born after you passed that maybe don't get that money. It could create some issues. Another thing to consider, which a lot of us don't really even think of, but let's say you had two children, one child has 4 kids, the other has none. The child with 4 children is obviously going to feel like they're getting a little bit more. Minors will receive their inheritance only upon receiving or reaching the age of majority, or possibly later. I've seen a lot of people set it for 25 just because they're a little bit more mature, or maybe when they go to school. And minors shouldn't be directly designated on an RSP or a tax-free savings account or insurance policy, just for the reason of having to have sorry, I lost my word, a trustee involved, sorry, or there could possibly be government agencies that get involved that take care of that. So what I'm going to do is I'm going to let Danny go through and explain some of the impacts that taxes and probate have on your estate.
Thanks, Mark. That was awesome. So it's common when Mark and I are sitting down with somebody for the first time to come across a will or an estate plan that is over 10 years old. They may have created it when they had young children, and now the kids are grown up and have kids of their own. So think about all the changes that could take place over, those 10 or 10 years, right? So that's why it's important, like Mark said, to review your estate plan and your will every 3 to 5 years. Not saying that you have to make changes, but it's always good to review these things in case we need to. And like we mentioned earlier, if you have any questions throughout the evening, feel free to throw that in the chat box and we'll get those answered for you as quick as possible. So the second part of a good estate plan is managing taxes and fees. There are 2 types of taxes at time of death. The first one being probate and the second being income tax. People are often more concerned about probate fees, but after you go through an estate analysis, it's income tax that will actually take up a bigger portion of your estate's value. So because income tax is the larger one, we're going to cover it first. So when you pass away, you have to file your final income tax return for one last time. And when you submit that final return, your income gets calculated as follows. Well, CRA adds up your regular income. So if you're employed still, all your working income. If you're retired, collecting a pension, that pension income gets included in there. And also things like CPP and old age security get thrown in as well as other sources. The second form being a deemed disposition of capital property. Think of this as your home, vacation property, or non-registered investments. So what the government says happens is basically a second before you passed away, you would have liquidated all your assets. And that includes the third one, your registered assets. So things like RSPs, RIFs, LIFs, and that all gets thrown into your income taxes. So the amount of taxable income you might have in the year of death could be significant. As a result, a large portion of your income may be taxable at the highest income tax rate. And in Manitoba, that's 50.4%. If there isn't enough cash or liquid assets in the estate may have to sell some of your assets, such as a family business or property, in order to pay the tax instead of going to your beneficiaries. So if the income tax payable at death will result in an after-tax value that's significantly lower than what you anticipate, you may want to consider taking out a life insurance to fund the difference. Now, there are methods to defer or minimize the income tax liability at death. The first one being a spousal rollover. So if you leave your assets to your spouse, they will roll over on a tax deferred basis for accounts like an RSP or a LIF. So let's stick with the example of an RSP and you designate your spouse. Well, given certain conditions in the Income Tax Act, that money can transition to your spouse with no tax consequences. When your spouse eventually passes away, that income or that money in their RSP account will now be included in their income for their final return. The second one is the principal residence exemption. So think of this as your home. If you only have one property, it's relatively straightforward. When you purchased your house to when you pass away or when you sell it, all that money that you made is tax-free. However, it gets a little bit more complex when you have more than one property. Maybe you have a house in the city and then a cabin at the lake. Then you want to work with somebody like Mark or myself or an accountant to determine which property you want to designate as your principal residence so you can get the maximum benefit when you do your tax planning. And the third one is charitable giving. If you decide to make a charitable donation, the charity will issue a donation receipt that can be used to offset your income tax owing. Now, depending on the size and nature of your gift, you could actually eliminate all of your income tax on your final income tax return. So there are a number of ways to give assets to a charity. You can name them as a beneficiary of your estate. You could give them publicly traded securities. You could use insurance policies to make those donations. So there's a few different ways, and each one has their different pros and cons. And then we're going to move into the second part, which is probate fees. So probate is simply the process in which a court confirms which will is the last will of the deceased. So that third parties like land titles and financial institutions can rely on it without fears that a different will might emerge later on. So when the executor goes to the probate office to have the will approved, they get charged a fee. And the way that fee is calculated is they take the fair market value of your assets and they minus off any real property incumbents, which is something like a mortgage, for example. In an attempt to try and reduce these fees, many individuals try avoid having assets go through their estate, therefore avoiding probate. And they do this by using joint ownership or direct beneficiaries, but in many cases, we don't actually recommend this. These strategies often result in a large asset being directly transferred outside of your estate, putting your representative in a difficult position when attempting to distribute your remaining assets. Some people believe that the best way to pass assets on to the next generation is to add their children as a joint owner of their whatever the account is or property or whatever the asset is. Generally speaking, we don't recommend this. Adding a joint owner may help to reduce probate fees since the asset's going to pass outside of your estate and directly to the survivor. This does not, however, reduce the income tax liability. You could also encounter several other issues. So one being unequal division of the estate. Say you had somebody getting the cottage and you didn't have this written down in your will anywhere. There could be unclear intentions of what you actually wanted to have happen to that property. The second one could be the impact of the child's marriage. If they have a marital breakdown, that is now included in their assets and could be subject to a division of property. Or even if your child has financial issues and they have to declare bankruptcy, that forms part of their assets as well. So there are some risks associated with that joint ownership. And the last one is capital gains, or capital investments. So if you have an investment account, for example, and you're generating income from those investments, you have to decide who bears the tax burden. If you want somebody to help manage your assets in the event you become incapable, you should be looking at a power of attorney. And if you're in a blended family with children from a first marriage, you should also be planning carefully before adding a spouse as a joint owner. Many different types of plans and policies allow for a designated beneficiary. A direct beneficiary designation can help reduce probate fees and may be useful if you're in a first marriage or a relationship, or you only have one beneficiary. So it's pretty clear cut. If it's just a husband and a wife, you want all of the money when the husband passes away to go to the wife. It's nice and simple, and we get to reduce things like probate. However, direct beneficiary designations are not recommended. As a result, if there's unintended consequences, so maybe you're not in that first relationship, or for example, you have multiple beneficiaries. So say you have 3 kids and they all have kids as well. So you have 3 children and then some grandchildren as well. If one of your children predeceases you and you have just your 3 children listed as beneficiaries, well, whoever passes away, their children could now be disinherited. The second one is minors. So with minors, there could be some issues with freezing of assets, and the government could become involved with it. So there's some planning that has to be done around if you want to give money to a minor. Young adults, usually 18, 19-year-olds, if they were to come into a large sum of money, they might not be as financially responsible. Maybe they go out and buy a brand new car and basically blow all the money right away. We want to prevent things from like that happening, and maybe have it going to them at age 25 or 30 when they're a little bit more responsible. If you have a beneficiary that has special needs, we could look into something called a Henson Trust. If that's the case, you'd want to sit down with us, because we're not going to go into that too much because it gets pretty complex. And the last one being a blended family. So assets go to the new spouse, and it's very possible that no one from your previous relationship or your previous children could get access to that money. So it's often best to designate an estate as the beneficiary and distribute your assets through your will. Now, one of our tools in our tool belt is insurance. So we're going to look at how insurance can help protect your family and strengthen your plan. So there's several reasons to have insurance. When it comes to estate planning, you can use insurance to create an estate to protect your family. If you need to replace your income, if something happens to you, or you want to make sure that all your debt's paid off or the kids still go to university or college, that's one way to facilitate it. The second one we can use is estate preservation. So when you do that estate analysis and you're finding that you're going to have to pay a lot of income tax when you pass away, you can use insurance to essentially pay pennies on the dollar, and therefore having the insurance pay your income tax, and the assets that you want to go to your beneficiaries can go to them, and your estate won't have to liquidate some of those. The last one is estate equalization. For example, let's say you run a family farm, you have one child that's involved in the farm and one that isn't. That's okay. So insurance can be used to provide money for the non-farming child, and the farm can go to the farming child. So the farm is still profitable, and the child that's not farming is still getting a fair share. And then the fourth one is you can maximize your after-tax value of your estate by using insurance as an investment. So there's a number of different ways that we can use insurance and leverage it. So how can we get started with an estate plan? Well, the first thing you want to do is identify your beneficiaries. Make a list of people and charitable organizations you wish to benefit from your estate. For the most part, it's not recommended that a will include a long list of specific gifts. Usually the easiest method is to divide the value of your estate into portions, and then allow your beneficiary to pick and choose which assets they want to receive as part of their share. Speak to your family if there are specific assets they want, and ensure that that's reflected in your plan. The second one is calculate the net value of your estate. So ask your financial planner to perform an estate analysis to estimate the after-tax value of your estate, and ensure that that value is sufficient enough to meet everyone's needs, primarily those that are dependent upon you. And if you're finding that there's a gap, we can use tools to fund that. So the most efficient way is to purchase life insurance, assuming that you are young enough and healthy enough to buy insurance at a reasonable rate. And the last one is update your legal documents. Speak to an estate planner or a notary or your financial planner to ensure all your documents are up to date and you have your updated beneficiaries. So what you dream of happening actually happens when you pass away, so that you're putting those steps in place so that your family can act upon your wishes. Everything Mark and I went over is just one piece of your overall financial plan. I'm going to pass things off to Mark now, and he's going to walk you through our process.
Awesome. Thanks so much, Danny. That really clarified a lot of what you and I have both been talking about this whole time. So hopefully that clears things up for the people watching as well. So just before we go on to our process, we've just got a few other questions that have come through, but I've got one here that I think that people are probably asking. So this one's coming from Jonathan, and he's asking, sorry, I'm just trying to read this off here. I know the consultation is free, but what does it cost after that? Well, that's actually a really, really good question. So all financial institutions have fees when you have investments with them. These are called management fees, or MERs, or management expense ratio. IGA Wealth Management is in the bottom 50 percentile in the market for fees. But the difference between us is we provide the highest level of service. We provide financial planning to 100% of our clients. It doesn't matter how big or small. So financial planning and those services are already built into that fee that you pay on your investments. It doesn't matter where you invest. So John, if you're not getting planning with your current situation, you're essentially paying for a service that you're not receiving. So on that note, let me actually show you guys what financial planning consists of, and you can make a decision on what you're getting at your institution. So why a synchronized holistic financial plan is very important. Well, I always like using the phrase your financial picture. We always want to have a really, really good idea of what your financial picture looks like. Well, a lot of places will look at and pick and choose certain things. We want to take a look at everything. So we want to look at your managing your cash flow. Preparing for the unexpected is a big one in there. So a lot of people don't talk about that, but Danny kind of touched on it with life insurances. There's tons of different ways of having that going on. So even when we're talking about your estate and protecting some of your assets or paying off debt, you could have creditor insurance that might be costing you a lot more than regular insurance. So as long as you're able to get it. Maximizing business succession, optimizing your retirement, which is huge. I've got a slide here at the end. We'll go through a little bit, just give you show you some of the tips and stuff that we can do. But at the top left here, we can see how sharing your wealth is built into there. So that your estate plan is built right into your financial plan. So the way that we work is we have, like myself and Danny, working with yourself, and we have in-house specialists that we have, because everybody doesn't know everything. We know a lot about it, a lot of stuff, but we don't know everything about everything. So we have in-house specialists like our tax and estate specialists, security and investment specialists, insurance specialists, mortgage specialists. The nice thing about having that is anything that comes up in your situation, we have somebody there to come in. Now, they don't have it on this slide, but we actually have a full department. Our head office is actually based out of Winnipeg, so we're a Prairie-based company, but we have a whole department called Advanced Financial Planning, and these guys have more degrees than their thermometer. Like, they're phenomenal. We can send off anything to them and then get it back right away. Nice thing about them is they're a big group of accountants and lawyers and stuff. So when they come back with stuff, we can take it over to your accountant and your lawyer, and that's who's on the left here. So your advisors, and we work hand in hand with them. So the nice thing about that is that you don't have to take information from us to a meeting with them and back and forth, and it makes things a lot easier. Just for an example, took a client out for lunch with his accountant before COVID all started happening. And in a 45-minute lunch meeting, we actually got everything all figured out for him. That probably would have taken 3 or 4 meetings at $300 an hour and saved him thousands of dollars going forward. So it was a really, really good meeting, and it made things really, really easy. Now, our process is a little bit different than anything you might have seen. So essentially what we do is we explore your current situation. So this is where I was talking about that financial picture. We want to get a good idea of what you look like right now. That gives us a good baseline. So if we go through and we have that, the next step is kind of my favorite part, especially with couples or married couples, especially. So clarifying your goals and objectives. We have a little worksheet that we do, kind of tells what your goals and stuff are. And what it does is a lot of times you'll have the wife or husband be like, well, I didn't know that you wanted to do that. It's great to watch the banter back and forth after, but it gives a real clear picture of where people want to be. You've worked all your life for your retirement, so you want to be able to enjoy it. So we take those two pieces of your current situation and your goals and where you want to be, and we develop a comprehensive plan. The beauty to our software is that we can run it through a program called a Monte Carlo that actually does over 1,000 different scenarios and stress tests the plan that we have developed. That will actually tell us how successful we're going to be. So it takes into consideration different market fluctuations and things maybe happening like health or really anything. Like I said, 1,000 different scenarios. Then what we do at that point is we get one of our investment specialists involved in customizing an investment program for you. And at that point, once we've got everything all in place, if you decide that you want to move forward with it, then we can implement your strategy and get everything all moving. So once we have that done, a lot of places will kind of stop here, and that's they've got the plan done, everything's all in place, they just kind of let it ride. We're very, very apt to sit down every 6 months to a year, or especially if one of those like milestones like I was talking about before come up, we want to review your plan, review your estate plan, review your will, make sure that everything's still moving in the right direction. People change, times change. We always want to be able to pivot and adapt to those kind of things. So now, if you decide that you wanted to go on and book a consultation, again, you can go onto the chat and click on the link there, and it goes right into our calendar. But when we go through the consultation, we can talk about very specific things to do with your situation, but some of the things that we have available that we can talk about, personalized advice on strategies to maximizing your estate plan. Again, that's something that's specific to everybody. We want to look at the top 3 strategies to help you reduce taxes in retirement. This is number 1 for everybody. Nobody wants to pay more taxes on your money, especially to the government, when you're in retirement. You want to keep that money in your pocket. So, and we also want to look at some strategies on lowering the impact of volatility in your portfolio. When Danny was talking at the start about the market and how the market's fluctuated so much, that's what we're talking about. We want to make sure that you're protected in the event that something like that happens. There's some very, very easy things that we can do and a lot more complicated things that we can do, but they're very, very easy for us to put in place, and anybody can do it. So, and we definitely want to talk about how making emotional investment decisions can hurt you and swing your retirement in the wrong way. But that's where having a financial planner in your back pocket to talk about these things and learn from can help you achieve your goals. So.
Oh, hey, you're still here. You must have liked the video. Well, if you haven't already, like and subscribe to the video so you can get alerts when new ones get uploaded. And in the description is a link to my calendar. Feel free to go in and book yourself an appointment directly, and I will see you there. Have a great day.